In this video, I'm going to share a surefire method or strategy for beating the stock market in both a total income basis as well as a total return basis. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. With this video, I'm going to revisit a set of videos that I produced in August of 2021, where I created 3 model portfolios, and I also promised that I'd be updating those portfolios. Here's how I'm keeping that promise. Now, I created an income portfolio, equal-weighted dividend income portfolio based on fairly valued dividend growth stocks. Then I created one that had more growth-oriented into it for both growth of income and growth of dividends. And then finally, I'd throw off another strategy of where I overweight several of the stocks in the portfolio so that I could generate greater income and still provide good results. Now, all of these portfolios were built and based on investing for specific objectives of certain investors. Some that were needing income, say a young investor who was looking to grow their money over, say, a 10 or 20-year period, so that when they finally did get into retirement years, they'd have enough money in their portfolio and enough income being generated in their portfolio to live off without ever having to sell their stocks. The second portfolio was one that was oriented for them to do a very similar strategy and grow the money over a longer period of time, a little bit lower yield, but hopefully getting more growth in the portfolio. And then the third portfolio I did was more of a high yield portfolio where I overweight several stocks in the portfolio so that I can generate a higher current yield for those investors specifically who are already retired and needed to get a higher yield on their portfolios. So these 3 portfolios were built. I'm going to provide links to those old videos or those original videos at the bottom of this video that you can go back and revisit. But today I'm going to upgrade them, and I'm very excited about this because there's 2 reasons why I've waited this long to update these videos. Number one is it's now been a little over 2 years, and it's been a long enough time frame to be able to start evaluating whether the strategy is working or not. And then the second reason that I'm going to do it here is that we've just launched a new advanced portfolio section on FastGraphs. I believe it's a game changer. It's a stock portfolio management system specifically that can really help you keep track and manage your stock portfolios better than any before and better than I've ever seen. So I've waited until we launched that. We just launched it a couple days ago. So I'm very excited to introduce that, and I'm going to be featuring that throughout this video. Now, I've got 3 portfolio reviews that I need to do. I'm going to do one today on a comprehensive look at the first portfolio, and then I'm going to create a part 2 and a part 3 to look at the other strategies that I utilized in that portfolio. Let's start out by going to FastGraphs, the fundamentals analyzer software tool here, and let's set some precedents and look at the S&P 500 so that we can kind of get a benchmark of what I'm talking about. Now, what I was really suggesting in the earlier videos was that the market was really overvalued. The orange line on this represents the fair value of the market with a margin of safety built in. And you could see there have been times when you could have bought the S&P 500 where it was touching that orange line, which would be basically a 15 PE ratio. And those were clearly the best times to be buying it. Since April of 2013, the market started to deviate from that and got up to where you're seeing this 18 to 20 multiple that the market's been trading at for the last several years. And then in August 24th of 2021, you see that the market had gotten extremely high. Even though it went a little higher after that, it fell, but now it's rallied again. And part of this is to basically illustrate the importance of Warren Buffett's famous quote, "Be greedy when others are fearful, and fearful when others are greedy." And right now, others are being greedy, so I really do think you should be fearful. Now, what I've done is I've then also taken advantage of some features in the FastGraph research site. I've gone into the settings here, and I've made this a $1 million investment in the S&P 500 so that I can compare apples and apples as I go through this portfolio feature with you. And I've also gone to where I've allowed any dates, okay? If I don't allow any dates, you have your normal bar here, okay? And when you look at the S&P at a big time like that, you get to see all that. But when I allowed any dates, out with 6 years, and then what I did was I went into the calendar here, the start date here, and I went through 2021, up through August of 2021, picked August 24th. Now this gives me the precise time that these portfolios that I built were running, so I have a precise comparison to the S&P 500. And I'll be showing you how those portfolios, or at least one today, how those portfolios performed versus the S&P 500. I'll give you a quick review of all three, and then I'll focus on the one, and then I'll cover more in depth the other two portfolios in future videos. All right, so let's get into the new portfolio advanced feature of fast graphs. And here I'm using equal weight model number one, where I equal weighted the portfolios. Now the internal rate of return was 8.99%. As you're going to see here in a little bit, the average return of the S&P was 7.23. So we beat the market on growth. The average income from the market was a little over $35,000. Here we've got $104,000. So again, we beat the market on dividend income with this portfolio. The current yield of this portfolio is 4%. Now remember, these were built with current yield in mind. The second portfolio was equal weight growth model number two. And here you see that the annualized rate of return was 11.44%. The income was $68,000, almost twice what the market produced. And it was also a significantly better rate of return. So the growth part worked. And then the third portfolio was one where I overweighted certain stocks and I went for high yield. And here you see the rate of return also beat the market with an 8% annualized number. It threw off $127,000 in income and has a current yield of 5.13%, but it obviously produced almost 3 or 4 times what the amount of income that the market was able to produce. But as I promised, I'm going to focus on Model 1 here today, and then I'll be covering more in depth Model 2 and Model 3 in future videos. So let's kind of orient you. This is the summary feature, first of all. And as you can see, the portfolio had approximately $1 million invested. Yesterday, it was up $18,000 alone, 1.74%. The total return since inception was $225,293. But I also want to point out you received $104,621 of income, which brought your net investment down to $845,000. And what this simply means is, like the great Will Rogers once pointed out, he's much more interested in the return of his capital than on his capital. So this is also a risk minimization. By getting dividend income from the portfolio, you are in effect getting a return of capital. And so as time goes on, you end up having less money at risk. The risk mitigation part of building a portfolio based on value investing into dividend growth stocks, which is that special strategy that is surefire to beat the market, is really what I was talking about. You want to not only invest in good dividend stocks, and I'll cover more on that in a moment, but you want to do them when they're at fair value. Okay, now this gives you the top gainers for yesterday and the top losers, and this gives you the top volume of the portfolio for one day for yesterday. Okay, and this is simply a graphic of how well the portfolio has performed. Again, it's up about 8.99% over that time frame. This gives you your asset allocation. You have 17% in mid cap and 82% in large cap, and that's listed again here. But then you can also look at sector diversification, and you can see all the various sectors and subsectors that you're invested in. And again, they're listed over here, so you can see where the most weight is. And of course, healthcare is the biggest weight in this portfolio because it's also been the most undervalued during that time frame. And then you go down here to these bubble charts, and you can point to any one of these stocks. You can look at estimated growth rate, and you can also look at estimated yield. All right, so these stocks, you can just point to the bubble and it tells you what the dividend yield currently is. This is Omega Healthcare, the estimated growth rate, in this case of AFFO or cash flow, and then how much weight in the portfolio and what sector it's in. So you can get more insight into your portfolio. The weighting section, again, just kind of summarizes that for you, and it shows you where the weighting is. Now, Cardinal Health is the highest weighting, as you'll see here in a moment, because it's been the best performer. Walgreen Boots Alliance is one of the lowest weighting because, as you'll see here in UGI, these stocks have been underperforming so far. And I do want to make a comment there. The whole portfolio at this point is not up. There are 8 stocks, as I'll show you in a minute, that are still down, but that same would be true of the S&P 500. Not all the stocks in the S&P 500 are trading at all-time highs. In fact, several of the stocks in this portfolio are also in the S&P 500. Now, the next place I want to take you to on this portfolio feature is into the holding section. The holding section gives you another great insight into how the portfolio is. It lists the weighting here. And again, you can just click on the heading and it goes lowest to highest, highest to lowest weight. You also have the gains and loss column. So you can list here, as I said, there are 8 stocks that have losses currently, and then the rest of them have pretty strong gains, with Cardinal Health being the biggest gainer. All right, so you can evaluate the portfolio very granularly by going through this. Okay, but the most important part of this whole thing is staying with the true blue benefit that Fast Graphs offer. You can go into each of these individual companies that are in your portfolio. And the first thing I want you to notice is there's a green dot and a gold line. This is your cost basis line. The green dot is simply what you bought it at. And we bought it on August 24th, 2021. We bought 400 and we'll call it 18 shares. The price was $119.68, and the PE ratio was 10. Today, the PE ratio is 16. The dividend yield is 3.44%, which is insights into how it's outperformed the market. As you can see, it's gone from being undervalued to modestly overvalued today. You can go through each stock in the portfolio. Amgen has been a really good performer. You can just see it graphically and visually here. Now, by the way, you're always going to have the daily volatility. That's why you have to give a portfolio time. This is a long-term investment strategy. You don't want to judge this in a month or 2 months or 5 months. You want to give it years. It takes time for a company to increase their earnings and increase their sales and increase their business so that the stock price can eventually track that. As you can see, Amgen has been overvalued and undervalued, but it eventually tracked its earnings, and it's done very, very well since we first bought it in August of 2024. Franklin Resources has had some earnings issues here since we built it, but I do want you to note that the dividend has grown in each year. And this, again, this is all about the income side of this has been good, but it's slightly underperforming its original price. Cardinal Health has been our best performer. It was extremely undervalued when we bought it after suffering several years of flat earnings. And then as earnings began to accelerate, the stock price has accelerated. And I would still call this stock fairly valued, but it's now given us a significant rate of return, obviously. If I shorten the time frame here to 6 years, I need to do that with all these stocks. Okay, and then I go into the Allow Any Dates button. And now I've got, I'm starting here because I went past a little bit when we bought the stock. So now if I go here to the calendar, and I can scroll through here and go to August 2021 and then click 2024. And I want you to notice I've produced the value since I've been able to calculate performance based on the day I bought the stock. So now when I go into the performance history, I've got the price and the performance based on the time frame I've held the stock. And you can see very clearly dividends here have been $9,094 versus $361 in the S&P. And this gave us a compounded rate of return of 38% versus 7%. Now that's with dividends reinvested. For an apples-to-apples comparison, I would suggest you uncheck that and look at how much income it's thrown off. $958 per 10,000 versus $355 in the S&P 500. And as you can see, you can go through this like this and go through your whole stock portfolio. Here you see Chemours, which has been an underperformer. You can go into the historical graph here and see that Chemours has been underperforming a little, or Chemours, I guess it's called, has been underperforming just very slightly, but again, it has paid a consistent dividend over this period of time. And you can now see the whole Eastman Chemical has been underperforming a little bit. Enterprise Product Partners is above its cost base. This is one of those very high-yielding stocks that are in the portfolio to give us that higher yield that I talked about earlier. Hewlett-Packard is about flat. We're getting to the point, I believe 3 to 5 years is the right time to start really judging a portfolio, and we're approaching 3 years now. And so I did feel, because we launched this new portfolio management system, that I would go ahead and show you the new portfolio system and go ahead and update these portfolios. But it's going to be much more emphatic when we get later in, because, for example, we do have some losers here. Altria is at a minor loss, but I believe this stock is worth a significantly higher value than the market is currently trading at. If I go into just the fast graph tool and just draw Altria from its inception to date, you can see that the market has applied a 15 or higher multiple most of the time except for the last several years, and I think it's still capable of going back up to those levels. Here you have your holdings. You can go through them. UGI is one that has not performed up to par. Let's go ahead and look at it. Clearly not performed up to par, but I do believe that it is one that is going to recover. I think the stock is worth $43 a share and is only trading at 24. So I do think, given enough time, we're still going to make some really good money in UGI. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, providing you this update on the model portfolios I built in August of 2024, and also featuring the new advanced portfolio features that we've just added to FastGraphs a couple of days ago. I hope you enjoyed the video. I hope you found it interesting and exciting, and I hope you recognize how powerful this new portfolio feature is going to be. So if you haven't invested in FastGraphs subscription yet, I highly encourage you to get one. Also, if you like this video, ring the bell, give me a like, subscribe to our channel if you're not already a subscriber. And I want to thank you all for watching, and I'll be doing part 2 and part 3 coming up very shortly. Thanks for watching, and we'll be talking again real soon.